Welcome to problem solving session number 6. My name is Bob Boylan, and what we are doing in these sessions is to give you students an opportunity to see someone work some problems. There's an old adage, see one, do one, teach one, then you understand. Well, of course, you have to see one do 10 million, then teach a few million before you really understand sometimes. But in any case, that's the basic idea, that if you can watch me solve a problem, it'll help you to understand the basic process and hopefully have value that you can apply elsewhere. Okay, this session, we are talking about managerial accounting. Now, in the financial and managerial accounting course, we spend half of a semester almost on managerial accounting, yet there's only one problem set. And the reason for that is that managerial accounting is more of a liberal arts kind of idea than financial accounting. In my opinion, financial accounting is based completely on problem solving, understanding relationships, understanding how information works. Managerial accounting, on the other hand, has to do with understanding how to ask the right questions. Its underlying premise is the economics of decision making. And so we spend more time trying to understand the information than we do trying to get the right answer. Because in managerial information, in managerial accounting, getting the right answer can be very difficult because the information isn't necessarily available. But it's very important to understand the process for trying to make a good decision. Now, in this session, I have chosen 6 problems from problem set 6. As we can see here, the problems 4, 8, 9. Number 4 is a make or buy kind of decision. It is also kind of a transfer, pricing kind of question. 8 is a break-even question. Break-even is a very powerful tool. 9, a special order. Should a firm sell at below market prices? Number 11, understanding the difference between absorption and direct costing. 14, similar to 8, a relatively simple break-even question. And 19, a present value question. Again, you'll see present values in the Boylan course, and I use them. I try to use them under every throughout the whole course, under every topic. Now, another thing that you should understand about this problem set is in managerial accounting, often I ask questions that are more essay related, asking you to think about issues and give me an opinion about what the right process is or things like that. I will not do any of those questions in this problem solving session. I am focusing today on those questions that have short, crisp answers that use the managerial ideas, but use the problem-solving orientation to come to number answers. So today's session is devoted to some fairly short questions that use managerial ideas. Now, that's not to say that the other questions in the problem set are not important, but again, those are more essay, more idea, thought-provoking type questions, not a venue for this kind, not great for this kind of a venue. Anyway, here we go. The first one we'll talk about again, number 4. Now, my assumption is going to be that when you are looking at this, you have already attempted the problem. So I'm not going to describe what's going on except to show the highlights in the question and to then use those highlights in an effort to give you an answer. Okay, number 4 has to do with never die division. So the players here, one is never die division. And never die division, they produce pumps. and they've been the sole supplier of pumps to the automotive division. So we have the never die division, which again is pumps, the pump division, the automotive division that sells these pumps and that buys these pumps, and subsequently there's going to be an outside company, the Sure Life Pump Company, is going to offer to sell to automotive. Now, typically, the pump division charges $10 per unit. And the Never Die divisions, right? This is the information from Never Die division. Now, one thing that is important to understand early on is to understand where the sales number comes from. It says here, sales, 25% of these sales are outside of the company. 25% of 2 million would be 500,000. So it sells 1.5 million inside, and it sells therefore 0.5 or 500,000 million outside. Now the price inside, it says here, is $10. So 1.5 million times 10 gives us $15 million. And therefore the price outside, if the total is coming to $21,250, the total for 500,000 on the outside is $12.50. And that then is equal to 6,250. That's working out well. But in any case, these two things total to the $21,250. That is the total sales. So again, we have inside sales at $10, outside sales at $12.50. And that's an important thing to realize up front. Now, next thing is that the variable cost to produce these pumps for the Never Die pump division is $8 per pump. The crux of question number one, right? Question number one is you have an outside division, right, that's willing to sell to the automotive division at $9. Should Never Die, which is the pump division for this company, lower their price to $9? In other words, they were getting $10 before. Should they lower their price to $9? Or should they just say, no, we refuse to sell at $9. We will continue to only sell outside. So that is issue number one. Issue number two is, suppose Never Die does other things. We'll talk about that in a little bit. Let's answer question number one. If you are the manager of Never Die, would you be willing to sell to the automotive division at a lower price, lower your price from 10 down to 9, and therefore meet the competition? And the competition was whom again? The competition was the Sure Life Pump Company. They're willing to sell at $9 per unit. And the answer is intuitive and hopefully fairly simple. Part of the answer is if your variable costs are only $8 and the automotive division is willing to pay you $9, your contribution to overhead is going to be $1 per unit, 9 minus 8. And that's going to help cover your overhead. Now, again, intuitively, unless you can sell virtually all of your capacity outside, unless you have that opportunity, it's likely to make sense to keep selling inside even at a lower price in order to continue having that $1 per unit contribution to overhead and profits. But let's do the analysis. Okay, so for the Never Die division, suppose they say we only want to sell outside. What does their income statement look like? If they only sell outside, then sales becomes $500,000 at $12.50 or $6,250. Their variable cost is $500 times $8 per unit, which is $4 million. but this low volume, 500,000, would have to incur the full cost of the fixed cost, the full cost of overhead in essence, which is $2 million. Hence, profit, or call it gross margin, right, because we're not including all kinds of other costs that could be in there, call it gross margin, under this scenario is about $250,000. And hopefully that makes sense. So if they if they do not sell inside at all, their gross margin will be $250,000. Now, again, intuitively, if they sell inside and outside, their gross margin will be the $250,000 that they get from selling inside plus $1 per unit times 1.5 million units, or $1.5 million. So again, intuitively, it should be obvious that their gross margin, if they sell inside and outside, will be $1,750,000. But let's do an analysis of that. So if they sell inside and outside, we'll have sales. And let's say we have in-house, outside, and total. And so sales in-house would be, let's see, 1.5 million times the new amount 9, which would be 13,500,000. Outside would still be 500,000, 0.5 million times 12.5. So outside would be 6,250 for a total amount combined of 19,750,000. Now, variable cost, again going inside and outside, variable cost would be 1.5 million times 8, or 12 million. And I'm going to use a K for 3 zeros there. Outside, there'd be 0.5 million times 8, which is 1/3 of that, 4 million. So the total would be 16 million. Now fixed cost, we could prorate them between inside and outside. And if we did, 3/4 of the fixed cost would then go to the inside, 1.5 million, and therefore 500,000, for a total of 2 million. Now the net result out here is that 18 million in cost, 16 and 2, from 1975 gives you 1.75 million. And that would be your contribution margin from going inside and outside. So the first question was, should this company go inside? Should they continue to sell inside at a price of $9 per unit? And the answer is obviously yes, right? Their gross margin increases by $1.5 million if they sell inside compared to giving up the inside volume and only selling outside. Now, that brings us to part 2 of this question. And part 2 of this question asks, suppose the Never Die division feels that they can increase outside sales by 1.5 million pumps per year. So in other words, Never Die is trying to replace the inside sales. Current inside sales are $1.5 million. They're trying to sell an additional amount to replace all those inside sales, given that they can sell at a relatively higher price. Now, the information then is that if they incur an additional fixed cost of $2 million and variable costs go up by an additional $1 per unit, if you'd come down to the sheet, please, so we can see what I'm underlining here. Eleanor, if you would bring the sheet in. in any case, so fixed costs increased by $2 million, variable cost by $1 million, and they assume that they can sell at a price of $12. Right? They were selling at $12.50 to the outside. Now they assume they can sell for $12. And the maximum capacity stays at 2 million. In other words, so they're not adding capacity, they're just adding productive quality things so they can, in fact, sell more to the outside. And now the question is, should the never die division, there we are. Let's quickly review what we just did. Again, fixed costs increased by 2 million, variable costs go up by $1 per unit, and the price decreases from 12.5 down to $12 on outside sales. And so the question then becomes, should the division reject the intercompany business and concentrate on outside sales under these conditions? And here we go. Sales to the outside, right? So if they in fact do that, sales to the outside would be 2 million times $12 per unit, or 24 million. Variable cost, and this again is under what conditions? Under the conditions that they sell outside completely to the tune of the full 2 million units. Variable cost is going to be 2 million times the new higher cost, which is $9, 8 plus 1. That gives 18 million total cost. Fixed cost is going to be the 2 million from before plus 2 more for a total of 4 million. Now, we subtract all this out, and what we get is the new profits, 24 minus 22, or $2 million. Now, we compare that to the other alternative, right, which is to sell partly inside and partly outside. And when we did that, total profit, and again, that was the analysis that we just did. When we did that, total profit was what? 1.75. So really, the decision here, if you're the manager of the pump division, is, would you rather make 1.75 million, or would you rather make 2 million? And that's not a hard question, right? I mean, 250,000 may not be much to some people, but it buys a lot of beer for me. So I would prefer to go with the $2 million. So obviously, that under the conditions of Part 2, the firm would prefer to revamp and sell outside. Because why? Because profit margins are greater. Now, this answer is a purely financial answer based on the numbers. There could be other reasons why they want to stay in-house. For instance, quality issues. There are other considerations, which is why managerial is a rich topic. But in terms of just numbers, in terms of just profit, in this example, the firm, the never die division, the pump division, would be better off forsaking internal sales at $9 and attempting to maximize outside sales at $12. So much for question number 4. Back to our roadmap. So our roadmap, the first one, make or buy and kind of transfer pricing issues. Next one is a break-even question. And the break-even questions usually are fairly simple. So the break-even question, question number 8. Here's a company that has initial sales of 50,000 units at $40 for $2 million. Variable costs are $1.1 million. Contribution margin, $900,000. Fixed costs, $765,000. The current net income, $135,000. Now, based on that information, compute the unit contribution margin, Well, first thing we need to do is let's put a few things in the margin out here, because it's fairly straightforward. First of all, in terms of dollars per unit, use Q for units, the sales price is 40. Call that, and then we'll put the percent out here. That's 100%. And then the variable costs are, again, if you are producing 50,000 units, the variable cost here will be what? The variable cost is $22 per unit. Now, the variable cost is also 55% of the price. The contribution margin, again, 50,000 units into 900,000, gives us an $18 contribution margin, or over here, 45% contribution margin. Fixed costs are $765, which we'll be using in our break-even. So the first question, compute unit contribution margin. Well, unit contribution margin would be 40 minus 22, or 18. So that's the unit contribution margin. And the units that must be sold to break even. So the next part is, how many units must be sold to break even? Well, the break even equation is fairly easy. So if we go to the pad, this is number 8. Break even is simply the fixed cost, which in this case is 765,000, divided by the contribution margin per minute, the contribution margin per unit, which is 18, and that gives us a break-even of 42,500 units. So that's the first part of A. Going back to the question, so this is 8A. The next part of A asks the question, bringing it back in, suppose that 30,000 units are sold above break-even. What is profit? Well, that's pretty easy, because we have 30,000 units. And what is the contribution to profit for each unit beyond break-even? And the answer is, it is $18, which is what this number represents, the contribution margin, the contribution to overhead and profit. So once you have reached break-even, any unit that you sell then becomes a pure profit. At the margin, that margin amount is pure profit. So we multiply that out, and 18 times 3 is 54, 540,000. And again, hopefully that makes sense. This stuff is not that complicated. Part B. Part B is, what is the break-even? Part B. What is the contribution margin ratio? Well, the contribution margin ratio is 45%. We calculated that earlier. And the break-even point in dollars. Well, the break-even point in dollars is simply fixed cost, 765, divided by the contribution margin ratio, which is 0.45. And so break-even in dollars would be $1.7 million. So if they sell $1.7 million, then they are breaking even and just breaking even. Now, the last part of this question is, suppose that revenues are 200,000 greater than expected. What would the total profit be? Well, it's a little bit confusing. What does greater than expected mean, right? And it's designed to reference the original amount right here. So what's going on is, if revenues are 200,000 greater than expected, this is the expected volume up here. So if they are 200,000 greater, then what's going on is we have an additional 5,000 units that's going to be produced. So we'll go to another page here. So this is 8B. This is the second part of 8B. And so first of all, $200,000 more than expected. divided by $40 per unit gives us a total of 5,000 additional units. Well, the initial sales amount was 50,000 plus this additional 5 gives us a total of 55,000 units under the conditions of 8b. So then the question asked, what will total profit be? And so we simply created a simple income statement. Sales for 55,000 units times the sales price of 40 gives us a sales amount of 2.2 million. And then variable cost would be the 55,000 times, $22 per unit, and that is 1210. For a contribution margin, subtracting that out of 990, then fixed costs would stay at 765. For a profit, and that's the question, what's the profit? Total profit would then be 225. So that then is the answer to number 8, part B, with the baseline being the information that was already presented in the question. So much for question 8. Back to our roadmap. 4, 8, now question 9. And so a couple of these questions are going to be fairly simple. This is a fairly quick question, luckily. Question 9. The key to question 9 is there is an operation, and there's someone offering to buy their units at a price of $7.75. Now, again, I'm assuming that you've read all this stuff, so the key thing here is, can they sell at $7.75? Go to the next page. We look at their cost structure. Their cost structure is they have direct materials, direct labor, variable overhead, and fixed overhead. Well, if we calculate their variable cost comes to a total of $6.50. Remember that the offer price for this special order is $7.75. And so at the margin, right, the contribution margin on the sales to this outside source is going to be $7.75 minus $6.25, minus $6.50, or $1.25 per unit. Now, do you or would you want to make this sale to this outside entity, outside your sales area? And the answer is, of course you would. Again, the numbers suggest that of course you would. Even though you can sell at a higher price in your normal markets, for a special order, as long as you cover your variable cost of delivering that good to the new separate market, then you would want to do that. However, in real life, you have to be very careful. Right? So again, the numbers say do it, but in reality, that may not be the best thing to do. And the reason is why? Because once your current customers realize that you're selling to somebody else at a discounted price, they want that same discounted price. And once you start discounting your price to everybody, your whole profit picture changes dramatically. So this only works if you can isolate out one particular instance, the special order idea, and it doesn't affect your normal profit and your normal product lines. Next question. Question 11. Understanding the difference between absorption and direct costing. This is more procedural, this kind of a question, but it yields very interesting and important results. Okay, question 11. Here's a company that operates for 2 months. It produces 20,000 units, in this case tons, in month 1, and has 0 production in month 2. Now, it sells 10,000 tons each month, and the selling price is $30 per ton. The manufacturing costs are $7 per ton. Think of those as variable costs, plus $210 in fixed costs. That's $210,000 in fixed costs. These fixed costs per month happen whether or not the plant produces any tons of product. Selling and administrative costs are $40,000 per month. So, A, prepare income statements using absorption costing. B, do the same thing for variable costing. C, compare these two and decide which one would be better for management. Now, again, your priors here should be what? What we teach in managerial accounting is that direct costing gives you better information. So, your priors on this should be that direct costing gives better information for decision making. However, here's an example that will hopefully reinforce that idea. And here we go. So number 11, if we create an income statement, and so this is 11, this will be the absorption. Now, people often complain about my handwriting, and I would like you to know that I can barely read my own handwriting, so I understand why you would complain. But be that as it may, this is, I think, the most efficient way to provide this information. So we have sales, and we have month 1 and month 2. And again, this is the absorption cost. Sales are going to be 10,000 times $30, or 300,000, no matter what. Then cost of goods sold is going to be 17.5 per ton. Now, where did that number come from? Under absorption costing, what happened is, in the first month, right, we'll come down here, in the first month, we had variable costs of 7. We had average fixed cost. Average fixed cost is equal to 210,000 divided by the number of units produced, which was 20,000. And that gave us a cost per unit of 10.5. Add that to the variable cost per unit, which was 7, giving us a total of $17.50 per unit. Now we use that $17.50, multiply that times the 10,000 units, and we get 175. Therefore, gross profit is the difference, 125. We subtract out selling and administrative, which was listed as 40. And then we have this additional cost, right? And this additional cost is the cost not of production, but the fixed cost in period 2 of 210,000, because they didn't produce anything in period 2. So profit in period 1 is going to be 85,000. Profit in period 2, subtracting out everything else, is going to be negative 125. Now, the key to understanding absorption costing is that we are prorating all fixed costs into the cost of inventory in each period. So the cost to produce inventory in period 1 then becomes the cost of inventory, the full cost, fixed and variable, which then becomes the cost of goods sold down the road. And that's the key to absorption costing. Now we talk about direct costing. With direct costing, we use a very similar. So this is question 11, but now we're using direct costing. Again, we have sales less cost of goods sold, giving us at variable cost, giving us what we might call contribution margin. Then we subtract out all fixed costs to give us, and I guess we'll subtract out fixed costs and selling and administrative. I was going to combine them together, but we'll show them separately, and to give us net income. So we have period 1, period 2. Sales are going to be the same, 300,000. So the key difference between absorption costing and direct costing is how we value the units of inventory that go out the door. Using direct costing, we do it at the direct cost. So in this case, it's going to be the 10,000 units times $7 per unit, or 70,000 in each month. That gives us a contribution margin of 230,000 in each month. Fixed costs in each month were the same. Fixed costs in this case of production, the 210. Selling and administrative were the same in both months, 40. Giving us net income, again, consistent across both months, of negative 20. Or we'll bracket that, I guess. Now the distinction here is that the direct costing doesn't artificially prorate only the fixed costs from the first months in inventory. And so managers, and I personally would argue that thinking about fixed costs as simply period costs, right? Thinking about the fixed costs of production as well as sales as what we call period costs gives us a better sense of what's going on at our company. It also gives us a better sense of the kind of a price we need to get at the margin for things like special orders, for things like make or buy decisions, things like that. So, again, hopefully that makes sense and is at least a little bit helpful. It's so the distinction between absorption and direct costing comes primarily in how we value inventory, and direct costing obviously values it completely as direct cost. Back to our roadmap. So what have we done? We've done make or buy, break even, special order, absorption. Another break even question. Again, these are short and sweet, yet I think hopefully very intuitive. So, it's 14. In question 14, we have fairly simple information. Fixed cost, 300,000. Variable cost, $2 per unit. Part A. Find break-even point in dollars at a selling price of $3. Okay, so how would we do that? So find break-even in dollars. Well, we can do it a couple different ways. In this case, again, it's a fairly simple formula. Take fixed cost, 300,000. Divide through by either if you divide through by the contribution margin ratio, that would give us break even in dollars. But in this case, we can divide through by the contribution margin, which is what? A $3 price minus a $2 cost. So we're dividing through by $1 per unit. Then multiplying that times the price, which is $3. And so break even would be 300,000 units times 3, $900,000. And this is what? This is question 14A. Question 14B. Find the break-even point in sales dollars at a selling price of $4 per unit. Well, if the price is now $4 per unit, again, fairly simple. It's the fixed cost divided by 4 minus 2, because the price went up. Multiply that times 4. And what that gives us is now break-even is only $600,000. And hopefully that makes sense, because as the price goes up, break-even should go down, because your contribution margin is larger per unit. The contribution margin in the second example is obviously 2. Question C. How many units must be sold at a price of $5 per unit to generate a profit of $150,000? Well, it's a small tweak of the equation. Now we take the fixed cost, $300,000, plus our profit expected, $150,000, and we divide through by the contribution margin, which now is $5 price minus $2 cost. And what that gives us then is 150,000 units. This is units. And that's the number of units to do what? To have a profit of $150,000. So break-even is a wonderful tool, and it's a tool I hope you will learn to use and that you, in fact, add to your repertoire. So long as you recognize the difficulties with break-even, and those difficulties are fairly obvious as we've gone over in class, that it is so simple that it makes life a little bit too simple, and you cannot expect costs and prices to remain the same. Last question for this session, and the last question is a present value question. It is William Joel. So Billy Joel is considering purchasing sound equipment. The sound equipment has a cost of $1 million. So we'll highlight the important items. The initial cost is $1 million. He also expects to have to spend an additional $20,000 in maintenance for each of the 15 years of ownership. He expects cash inflows to be $150,000 in periods 1 through 6, and then $200,000 for periods 7 through 15. And the question is, should he purchase the equipment if his required rate of return is 14%? And this is a fairly simple, it's a net present value kind of a question. You're comparing the present value of the benefits to the present value of the cost. Now, the point that I'm hoping comes true here is that in present value analysis is using the managerial decision rule and has been from the very beginning. This net present value idea is valuing each project at the margin. It's comparing the extra benefits with the extra costs. That's what net present value does. So in this case, what we need to do is figure out what the extra benefits are, and then compare those extra benefits to the extra cost. Now, the first thing I suggest you do, as is always the case, is let's draw some pictures. First of all, let's talk about the costs. So the costs are $1 million up front, plus an additional $20,000. So if not in period 1, but not in period 0, but period 1 through period 15, you expect to see $20,000 in cost for using this sound equipment. So the present value of the cost then becomes $1 million plus the present value of an annuity of $20,000 for 15 periods at 14% per year. And when you add all that up, the present value of the cost comes out to be $1,122,843. Now, the benefits. The benefits are what? The benefits have two time sequences to it. From period, again, at the end of period 1 to the end of period, now what was it? The end of period 6. So period 1 through period 6, you expect the benefits to be $150,000. And then in period 7 through period 15, the benefits are $200,000. So now the question is, what is the present value of this stream? And it's not that difficult a calculation. It just takes a few steps. One way to think about it is, and the way I usually do it is, I take the present value of the first stream, and so this is the present value of $150,000 for 6 periods at, in this case, 14%. Now to get the present value of the second stream, again, that's a little more complicated. First I take the present value of the second half, and I bring it down to the end of the 6th period. So 6 and 15 is 9. So this would be the present value of an annuity. And the annuity is for how much? $200,000 for 9 periods at 14%. And then what I do, and I'm using a different color to do that, that gives me some number. But then I have to take the present value of that number, right? In order to go back to the present, I need to take the present value of that number for 6 periods at 14%. Now when I do that and I add all that up, what it comes down to is that the benefits turn out to be 1034, roughly $1,034,000. So the present value of the benefits, $1,034,000. Compare that to the present value of the cost, $1.122 million. Hence, the cost is greater than the benefit. Hence, Billy Joel should not purchase this sound equipment. So, again, in this case, it's slightly more complicated, but the basic idea is compare the extra benefits to the extra cost in a present value sense. And so managerial decision making often boils down to that, comparing the extra benefits with the extra cost, but more complicated is to make sure you do it in terms of present values. So in this case, you took the present value of the cost, present value of the benefits. The net is that the costs outweigh the benefits, hence don't do the project. Well, that finishes this session. And I hope these sessions have been very valuable. Thank you very much.